Hello, Assalamu alaikum. Okay, so today we are going to discuss November 2019 uh, paper 22. We have done two questions yesterday, and today, inshallah, we'll continue with the third and fourth question. So I'm sharing the paper. Okay, class. Now, in this question, what we have to do, we have to make key accounts of three partners. This is a question of partnership admission, and in partnership admission, we have to see what is happening. Okay. Now, Miguel and Bernard are in partnership, sharing profit and losses in the ratio 2:3 respectively. The statement of financial position for the business at 31st May 2018 has been provided. Okay. Now, the partners admitted Eddie to business on June 1st, 2018. The following information is also available. Eddie introduced non-current asset values at $40,000 and cash $50,000. Okay. The new profit sharing ratio will be 5:3:2 for Miguel, Bernard, and Eddie respectively. Goodwill was valued at 40,000 and will not be retained in the books of account. This is not a purchased goodwill. Are you getting my point here? This is not a purchased goodwill. This is a goodwill to old partners. Are you getting my point here? Because the incoming partner is not smart, the old partners are smart. So the goodwill is going to the old partners. Okay. Non-current assets 31st May 2000 were revalued at 210. Inventory had an NRV of $45,000 and provision for irrecoverable debts of 5% trade receivable at 31st May 2018 was made. Prepare next page the partner's capital account on 1st June 2018 following the admission of Eddie. Okay. Now what we have to do, first we have to make this capital account, and before making this capital account, first thing we have to do is to make account for revaluation. So when we are making an account for revaluation, what we have to do, we have to make here revaluation. Now, in revaluation account, okay, now we have to write revaluation account. Okay. Account. Okay. Now see the changes in asset accounts. Okay. Now non-current assets are revalued at 210. Non-current assets are 175,000. So 210 minus 175,000. 175,000. The answer is 35,000. So the asset is going to be debited and revaluation account is going to be credited by 35,000. Getting my point here? Reason is your non-current asset, NCA. Okay. Now, then we have to change the value of inventory. So inventory is going to be created and revaluation is going to be debited. The NRV inventory is of 60,000 and NRV of inventory is 45,000. 60,000 minus 45,000 is equal to 15,000. So revaluation is going to be debited by 15,000 and inventory is going to be credited by 15,000 due to the change in NRV. Okay. Now, a provision for irrecoverable debts. So we have to create provision. So provision is going to be created and revaluation is going to be debited. How much? This is 5% of trade receivables. Trade receivable is 48,000. Multiply by 5%. So 2,400. So this is 2,400. Now, what is the balance of revaluation account? 35,000 credit minus 15,000 minus 2,400. This is 17,600 is balance CD. Balance CD is how much? 17,600. This 17,600 is going to be divided among all partners in the ratio of 2:3. Mitchell 2 and Bernard 3. So 17,600 is the balance, and which is going to be divided among partners in the ratio. So to profit from revaluation, give it to, now I will write off the 17,600 and I'm doing it here. MIGUA will get how much? 17,600 multiplied by 2 upon 5. So that would make how much? 70,600 multiplied by 2 divided by 5. 7,040. 7,040. And how much? The next one named Bernard. Bernard will get how much? 17,600 multiplied by 3 upon 5. So he will get, or he will, sorry, Bernard will get 17,600 multiplied by 3 divided by 5. Answer is 10,560. Okay. Done. So profit from revaluation is going to be debited, and this profit is going to be created into the old partners account. Now, what we have to do here, we have to write first balance BD. Balance BD, the starting capital of Miguel was 100,000, and Bernard is 145,000. Done. Okay. Now, goodwill. Goodwill is going to be divided among partners in the ratio of 2:3. Goodwill amount is 40,000. So 40,000 multiplied by 2 divided by 5. 16,000 goodwill is for Miguel. And 24,000. 40,000 minus 16,000. 24,000 goodwill is going to Bernard. Okay. Then revaluation. Revaluation is going to Miguel 7,040. Yes. 7,040. And this is 10,560. Okay. Now, this is all done. Goodwill and revaluation, everything is finished. Now, introduction of Eddie. Eddie is bringing cash 50,000. So what we do? Bank debit, and Eddie is going to credit. Eddie is going to credit. How much cash? 50,000. Now, he's bringing assets. So assets are going to be debited, and Eddie's capital is going to be credited by 40,000. Done? Okay. Now the goodwill of 40,000 is going to be divided among the partners in the new ratio because they don't want to retain goodwill in the bank account. Oh, sorry, in the books. So goodwill is going to be this goodwill to old partner will now reduce capital of all the partners. Now, 5, 3, 2, 10. So 40,000 multiplied by 5 divided by 10. 20,000. So she will suffer 20,000. Miguel's share is 5 pound 10. Okay, Bernard's share is 3 pound 10. So 40,000 multiplied by 3 divided by 10. 12,000. And definitely no need to calculate it. Okay, now balance CD. $100,000 plus 16,000 plus 7040. 123,040 minus 20,000 goodwill. 103,040 is the balance capital. 103,040. Okay. Now second one, 1,45,000 plus 24,000 plus 10,560 minus 12,000 goodwill. 167,560. 167,560. Then adding 90,000 minus 8,000, 82,000 is a closing balance of 8. Getting my point here? So the total here 90,000. Here total is 179,560. Here total is 123,040. Same here 123,040, 179,560 and 90,000. And what you should not forget, please write balance BD over here. Don't forget to write balance BD over here. And balance BD is 103,040, 167,560 and 82,000. Done? This is it. This is how we have to make the current accounts. And thanks to Almighty Allah, in A levels you just need to fill it. You don't need to draw anything. MashaAllah, that's good. Okay, so we move further. Okay. Now move to the next question. On 1st October 2018, following changes in terms of the partnerships were agreed, all the cash introduced by AD was converted to a loan at an interest of 6%. The cash which is given to the business as a capital is turning into loan. Getting my point here. AD would also receive a salary of 12,000 per annum. Okay. The profit sharing ratio was changed to 2:1 for Miguel, Bernard, and AD respectively. It was agreed that no adjustment for goodwill was required. The draft profit for the year ended 31st May 2019 before interest on loan was $39,000. This had accrued evenly throughout the year. Now, if they are getting 39,000 profit throughout the year, divided by 12, monthly profit is 39,000 divided by 12. Okay, multiply by this is 50 multiply by 4. Okay. See, now we have to make two appropriation account in two columns. Okay. One is you can say for one is for 4 months and the other one is for 8 months, because after 4 months they have shifted or they've changed the partnership requirements. So we have to make appropriation for 4 months before the changes and then 8 months after the changes. Okay, so we have to be very much careful for that. Okay, are you getting my point here? Okay. Okay. Now, for 4 months, and here we write for 8 months. Then sign here. Okay. Now see profit. Okay. Now profit is 39,000 for the year. It means 3250 per month, and for 4 months 3250 multiplied by 4. Answer is 13,000. So here profit for 4 months is 13,000. Okay, minus 39,000. So 26,000 is profit for 8 months. Done? Okay. Now see loan interest. What we have to do first, we have to deduct the loan interest. Achha, loan interest, total cash introduced by Eddie was 50,000. 50,000 multiplied by 6%. Multiplied by 6%, multiplied by 8 upon 12. So the answer would be answer would be 50,000 multiplied by 6%, multiplied by 8 divided by 12. Answer is 12. This is done. Here we do not have any interest. Okay. Now, next step. This will remain 13,000 and this will become 24,000 because we have to pay interest in the last 8 months of the year. Now, salary to now salary to AD is decided 12,000 per annum. So 12,000 multiplied by 8 upon 12. Okay, because he is getting salary 12,000 per annum after 4 months of business. So he is not get full salary of 12,000, but for 8 months, multiplied by 8 divided by 12, the answer would be definitely 8,000. Getting my point clear? Okay. Then share of profit. Now, 13,000 is going to be divided between the partners in old ratio. The old ratio at the time of admission of Eddie was 532. So 13,000 multiplied by 5 divided by 10. So Miguel will receive how much? 6,500. 6,000. Okay. And Bernard will receive how much? 13,000 multiplied by 3 divided by 10. 3,900. 3,900. And Eddie will receive how much? 13,000 multiplied by 2 divided by 10. 2,600. 2,600, and this is how profit is going to be divided 13,000. And what is left? If we deduct all, we'll get a 0 over here. Done? Okay. Now after this agreement, They are left with how much? 24,000 minus 8,000. We have left with residual profit. How much? 24,000 minus 8,000. Answer is 16,000. 16,000 is going to divide it in new ratio, and the new ratio after 2 to 1. So 16,000 multiplied by 2 divided by 5. 6,400 for begin. 6,400, and definitely same for Bernard. And 3,200 for Eddie. And this is how 16,000 is divided, and we are left with nothing but a big zero. They have divided all the profits. Okay. This is done. Next, you move to the next one. Why give two reasons? Why partnership? Why keep separate current? The capital account, actually, this is called fixed capital account system. When you keep capital accounts and current accounts separately, it is called fixed account system, fixed capital account system. And the second, if you keep only one capital account for everything, in other words, it is called floating capital account. Now we are following. When we have a current account, we have a fixed capital account. Fixed capital account means we can easily know actually how much was introduced in the partnership by the partners every time, how much actually they have invested in business, and we can easily calculate interest on capital from using this fixed capital accounts. And in current accounts, we would know, okay, what is actually interest on drawings, all the profits, all the taking outs, everything is done through current. This is the advantage. This is why we keep separate account for current and capital. Are we left with something? See. Now question number 4. Okay. Coming to question number 4. It's about cost accounting. Okay. Now the two drawbacks. Budgeted figures are estimated figures, and they can be misleading, and they can lead to over or under absorption. And over absorption means the cost price is very high. Cost price high means you have to keep selling price high. Under absorption means you have to keep the prices low, or you may suffer, or you may keep selling price low and you will suffer. Okay. Now 4A. Okay. Aramis factory comprises 3 departments: drilling, finishing, and maintenance. The maintenance department cost consists of maintenance engineers' wages. The manufacturing process is machine intensive. The overheads of drilling and finishing departments are made up of allocated costs and an apportioned share of maintenance department. The following budget information for the 6 month ended 31st March is available. Allocated costs, uses of maintenance 38.62%. Machine hours, allocate the maintenance department cost to the drilling and finishing department. So what we have to do, okay, we have to write over here drilling, finishing, then now allocated cost, dollar 435,720. Finishing department, dollar 748,900. Maintenance, $208,000. Done. Now, apportionment. Cost of maintenance department, 208,000 multiplied by 38%. 79,040. 79,040. What about this? 208,000 multiplied by 62%. 128,960. 128,960. And maintenance cost is finished. 200. Done. So total cost. Okay. Total department cost. We add 435,720 plus 79,040 514,760. 514,760. And here 748,900 plus 128,960 877,860 877. And here dash 0 dash 0. Okay. Now calculate to 2 decimal budget to hold absorption rate for the drilling and finishing department. So drilling and finishing. That's the total department cost. Drilling is 514,760. 514,760. 514,760. What about 877,860? Okay. Now, basis of apportionment is budgeted machine hours. Budgeted machine hours, how much is for department? 27,530. 27,530. And for finishing is 32,270. 32,270. Okay. So what would be the rate? If we divide them, what would be the rate? Overhead absorption rate. Overhead absorption. Five 14760 divided by 27530. Answer is 18.69. So we can make it $18.7. 18.7. Now what about this? 877,860 divided by 32,270. Answer is 27.20. $27.20. Done. We got 2 marks. The following information relates to maintenance engineer due wages during the 6 months period. Total hours worked 7,500. Total basic hours worked 6,800. Basic pay $30. Overtime 1.5 times the basic rate. Okay. Now the basic hours 6,800 multiply by $30 is equal to 6,800 multiplied by 30. 200 and $4,000. Yes. 200 and $4,000. Now, what is the overtime? 7,500 minus 6,800. Overtime is for 700. So 700 is overtime. Multiply by $30. Multiply by 1.5. Because we are paying time and a half for overtime. So 700 multiply by 30 multiply 1.5. The answer is 31,500. 31,500. So total workers, maintenance department worker wages would be 235,500. 235,500. This is the answer. And mashallah, we have not. Okay, done. Okay. In addition to actual maintenance wages, the following actual information for the 6 months ended 31st March has been made available. Total overhead cost daily and total machine hours. Okay. Calculate the over and under absorption of production overhead for each department for the 6 month period. Okay. Now what we have to do again, we are going to write here drilling, okay, then finishing. Done? Drilling and finishing. Okay. Now what to do? Total overhead cost. Actual. Dollar 427,360 and dollar 713,630 maintenance. We calculated 235,500. So we have to divide this cost. Portion 235,000 and the percentage was 38 and 62%. Okay, now we are working on real figures. 235,500 multiplied by 38%. 89,490. 89,490. And here 235,500 multiplied by 62%. The answer is 146,010. 146,010. Done. And maintenance cost has been 235,500 is approximately. Done. Now get the totals over here. Four to 7, 360 plus 89,490. Answer is 516,850. And here 713,630 plus 146,010. Answer is 859,640. 859,640. And here this is done. Now actual machine hours for drilling is 25,110 and finishing 31,976. 31,976. Done. Okay. Now budgeted machine hours. Budgeted absorption rate. Absorption rate is how much? What we have calculated earlier. That was we have to go 18.7 and 27.2. 18.70 and 27.2. Okay, now after this, when machine is, we are using machine for 25,118, 110 and 31,976. So according to our budgeted absorption rate, our overhead charge would be 25,25110 multiplied by 18.7. The answer is 469,557. 469,557 dollars. What about here? 31976 multiplied by 27.2. 31976 multiplied by 27.2. Answer is 869,747. 869,747. Okay. Now, over or under absorbed. Over, under absorbed. Now, in drilling machine, we have under absorbed. It is 516,000 total, and we absorbed only 469,000. So it is under absorbed. The answer is in answer is positive. 516,850 minus 469,557, 47,293 under absorbed. 47,293 under absorbed. Now what about this? 859,640 minus 27.2. Oh, sorry, 859,640 minus 869,747. Answer is 10,101 in bracket. 10,107. This is over. Done? Okay. Now, Arami's accountant is he uses marginal cost is okay, direct material 710, direct labor, drilling finishing, overhead absorbed, drilling finishing, selling and administrative cost 280. Okay. Half of the selling and costs are variable. Okay. RMS requires that all products achieve a profit margin of at least 15%. A new customer has approached Aramis and offered to pay him 1300 for his product. The normal selling price for this product is 1750. Advise Aramis whether or not should accept the order. Justify answer using both financial and non-financial factors. So if we consider financial factors, what happens if considering financial factor? See the contribution. See the contribution. This is 1300 selling price minus direct material 710 minus 225 minus 85 minus 100 and minus 140 of the selling and 1300 minus 710 minus 225 minus 85 minus 140, the half of selling addition cost. So 140 is the contribution. Contribution is positive. Again, we cannot achieve the required profit margin of 15%. Getting my point here. And directly we are going to suffer a loss of 160 with $160 as loss. Achha. It might be possible that fixed overhead absorption rate might be not accurate. This is a problem. Non-financial factor includes if you are giving them 1300. What about those customers who might give us about 1750? First thing, is he reliable customer? Will he give repeated purchases? And sustaining loss means no. Getting my point. Now, 4 factors you should consider. Its supplier is quality, yes, price, okay, discounts and credit terms, okay, and delivery within time. Simple. Oh, we have finished. So, inshallah, see you tomorrow with the new paper, next paper, A2, 2019 November, inshallah. So, take good care of yourself. You're welcome for suggestions. If you want to ask anything, you want to clarify something, if any topic is making you trouble, you can ask me anytime. Subscribe my channel and stay blessed. Allah Hafiz.